inversion fair value gap. ICT, how do you know when you're doing your live trades and you're annotating them, you're calling an inversion fair value gap before it even forms, before it even trades there? Right. That's authorship. You would expect that, right? So let's go into it here. From this candlestick's low to that candlestick's high. Are you having fun? Are you learning anything today? Because I tell you, man, if I was my 20-year-old self and some guy was on the internet showing me this stuff over live price action, I don't know, I would be giddy. So now think, okay? If I'm bullish, if I'm expecting price to go up to here, and we're only right here, and we're trading up into it, everyone else that thinks that they see this as a liquidity void, or stocks being hunted and a liquidity void, and we're going lower, they would see that as a short entry. Not me. Not me. And I can say that because you watch me do it example after example of live executions. When I called it on Twitter a lot, I would say, okay, take that fair value gap extended to the right. What am I telling you? I'm telling you that this right here, this sell side imbalance, buy side inefficiency, where the candlestick's low of that candle right there, which is that. Let me move it over just a little bit so you can see again. Let me zoom in actually because I want to make sure you understand exactly what's going on here. I want your money's worth, okay? So this candlestick's low and this candlestick's high right here. That portion on this candle, that's what I'm highlighting. What is that? The algorithm will go right back to this time frame, right back to this range in price action, being this. That candlestick's low, and this candlestick's high. And we're gonna darken up that rectangle's mid level. Okay, and I want that to be bolder like that. Okay, so that's what I'm highlighting there. Okay, and let's go back out to. Oops, a little too far. Already, some of you already see what's going on, don't you? I can't believe it. I can't believe this stuff really works. So because I'm bullish, I'm going to look at old sell side imbalance, buy side inefficiencies, or down close fair value gaps as a rock climber. Okay, I'm going up. I'm trying to climb the surface of this rock surface to get to this liquidity. And maybe if I'm strong enough and hold on long enough, I might be able to get to the zenith of that high back there, like I talked about real time before it did it. If that's the case, I know that this imbalance exists. Because if this is there on the sell side delivery, part of a what? Part of what? A market that is potentially going higher, then I'm going to treat this as a foothold or a hand grabbing point as a rock climber. And I'm going to wait for it to trade up above it. My hand's going to use it to pull me up higher in my trade. And then I'm going to wait for it to, I'm going to get above it, and then I'm going to trade long when it moves into this area. Why? Why should I do that? Because it's going to act as support. Because why? If it's going to go higher, it's inefficient over here because it went down on this candlestick. An efficient delivery and repricing for that range between this candle's low and this candle's high would be seen with candlesticks that go down in that same specific range that's highlighted in orange. Once we got above it, what did it do? It traded down to the low of it. And then what happened? Oh, look at that. Some mysterious movement to the higher side. And it ran into the buy side. Did it stop there? No, it ran right to the level I told you it would reach for. Okay? Is that hindsight, folks? Is that hindsight? Because this is the logic that I use every single time I'm making executions. Sometimes they don't pan out. I get stopped out. My entire move isn't given to me. Sometimes I enter with a pyramided entry, and I build in, and I absorb a little bit more drawdown in the trade that at the time I didn't want to see that much, but still I have to manage it. Just like you're going to have to manage. Every trade you get into, you have to be a manager of that risk. And every trade opens as a losing trade. You have to overcome the initial separation between where you bought and the spread, and you got to overcome the cost of that commission that you're going to pay, getting in and getting out. your real-time costs. So every one of us are losing traders, and you have to trade your way out of that. So the market does in fact do what? It trades down into the lower end in there. Now, before I start the live stream, and I gotta get to this part because then we'll be at 9:30 where we can watch the opening range. I think I've already explained enough in here to justify why that's an inversion fair value gap. Inversion fair value gaps are old inefficiencies that are opposed to the trade direction you're in. When you understand this, you will understand how also my market maker models are not Wyckoff, because this right here is your unicorn. Second stage reaccumulation, smooth consolidation, smart money reversal, low risk buy, accumulation, reaccumulation, second stage. Whoop, whoop, whoop. Where's the biggest move? Right there. Hello. So, oh, I love this. Anyway, we're going to go down into the 1 minute chart. Okay, so now we have all the details over here on the 15. We can see the same thing being shown on the 5 minute chart. Look at the bodies. What are they respecting? Midpoint of that inversion fair value gap. That's a signature.